Hell is coming. I'm your host, Steve Metre, and thanks for joining me today. In our show today, the unthinkable just happened and is now officially confirmed. And what I want you to understand is the political elites tried to rebalance the economy. And as you're about to see, what they actually did was far worse and is something that's going to have dire consequences to every American. Now, let's head over to Bloomberg, where we picked today's story up with the headline, as U.S. inflation broadly cools, bolstering case for Fed rate cut. And on the surface, this appears to be exactly what the political elites wanted, a simple rebalancing of the economy to bring demand down in line with supply. But as you're about to see, what they've actually done is devastating. It's going to affect everybody. The so-called core consumer price index, which excludes food and energy, climbed 0.1% from May, the smallest advance since August of 2021. The year-over-year measure slowed to 3.3%, which is the slowest pace in more than 3 years. And this is something that not even the Federal Reserve and many Americans believe would happen. Everyone thought that consumer prices were going to stay elevated, in fact, surge higher, much like they did in the 1970s, but the evidence becomes clear that inflation is indeed cooling, but it's the damaging effects it is having in other parts of the economy that we'll look at here shortly. As the consumer price index, you see in blue against the core CPI, again excluding food and energy in red, and that dotted green line across the horizon, that's the Fed's 2% target. And now you can see what looked like sticky inflation is actually being seen as just a mere plateau on another leg down, putting us within a matter of months of hitting the Fed's 2% target and seeing what will be the first of many rate cuts. Because again, what the political elites actually did to the economy wasn't rebalance it, they're destroying it. And here you can see why we knew inflation was coming down despite what many experts said. When we overlay the yield curve, this is a 10-year minus 2-year treasury yields, and it's shown inverted when 2-year yields are higher than 10-year, and that's abnormal in an economy. And you see that inversion here in the purple line, and that inversion predicts declines in inflation. You can see here going back to the late 1980s, early 90s, sure enough, inflation came down. You look at the early 2000s, going to the dot-com bubble, inflation fell. And around 2006 to 2007, the curve inverted once again. And while oil caused inflation to jump, it came crumbling down once again as the yield curve predicted. It even happened pre-pandemic, and now we face the second longest inversion in history, and what it's predicting is that inflation is going to come down again in a major way. It's not just going to get to the Fed's 2% target, it's going to blow right through it, and that has dire consequences again to every American. In addition to slower rental inflation, the cost of other services like airfares, hotel stays, and inpatient hospital care all declined from a month earlier, and you would think airfare and hotels would go up as Americans were hitting the travel season en masse, but as it turns out, they just don't have the money to spend on travel, pushing disinflationary effects into, of course, the travel industry. For goods, new and used vehicle prices led to broader decreases in core goods. The figures add to evidence that inflation has resumed its downward trend after a flare-up at the start of the year, while broader economic activity, and here's the key word, appears to be slowing. And this is a danger sign for the economy, because it doesn't mean they rebalance things, it means they're actually destroying it. But something that should be rebalancing to the upside, that's your brokerage account. Look at this. U.S. crude oil prices fall 1% as market assesses Tropical Storm Beryl impact. We had that from a few days ago. And look at this, back on June 12th, we told our CTA Time Pro subscribers, and these are people who subscribe to our report, that we look at the machine position. When it's in deep short position, the machines are betting on the downside and price moves against them, when the machines have to cover, and that's our signal to make some returns for our subscribers. And you can see they were stopped out on July 8th using our signals, using our stop loss levels for a nice 4.87% gain. And as of yesterday's business close, our CTA Time Pro, we're sitting on 11 open trades, 82% of them up. Do you know how hard that is to achieve? Most successful traders barely even get 50% of their trades right. We added 2 today. Maybe you like to trade the technicals. We look at the RSI, the MACD, and other technical signals. We aggregate them together with a proprietary overlay. We've got 17 open trades. A whopping 71% of them are up. We put on 2 trades to the report today. And what do you get every day? The report. You get the signals that we're generating. My opinion, what I think are the best ones, the stop loss levels. We track the trades and returns for you every week, and we update our stop loss levels to help make this easy for you. And here's the best part. You too can be a successful trader. You can beat the odds. We give you a 30-day trial. Jump in, find out how to start making money trading instead of being on the bottom 50%, because right now deflation is starting to move into the U.S. economy. Many said this would not happen. Here you see the month-over-month print at minus 0.1%, bringing the year-over-year comparable down to 3. That is now 1% within the Fed's target zone. And of course, it won't need to get down to 2 before the Fed cuts, because there's a problem that they did not anticipate, and it's starting to happen. As shelter prices, which is the largest category within services, climbed 0.2%, the smallest gain since August of 2021. Owner's equivalent rent, a subset of shelter, which is the biggest individual component of the CPI, climbed 0.3%, the tamest in 3 years, both of which are expected to come down. And with all of the building and multifamily going on around the country, we're expected to see further disinflationary forces. But look at this, excess supply has now led to heavy discounting. This from the Delta chief executive officer. Like everyone, you get impacted, and that's the problem, because the political elites wanted to bring demand down in line with supply, but post-pandemic, what actually happened is the supply chain normalized. The economy started to return back to where it was. Supply went up, and they continued to restrict demand, and that is having a serious impact on the economy. What it indicates is that indeed hell is coming. I'm going to show you exactly what that is, as there are signs that consumers are growing increasingly sensitive to higher prices. Here we see that Pepsi reported weaker than expected revenue growth as budget-focused shoppers wait on the volume of goods sold. The salty snacks category has been particularly lackluster, and what that means is people have less money to spend. You talk about bringing demand down. The problem is they brought it down too much, and it's accelerating to the downside as consumer wallets go empty. And a separate report on Thursday looking at the inflation data with wages published this last week showed real or inflation adjusted earnings growth has been positive for the last year. But that makes no sense, and even though the number is actually correct, what it's telling us is there's some other problems with the economy. Debt service costs are too high. Consumers are now gripped with higher energy costs at the pump. And what did we just see go up for everybody? Well, insurance costs went up across the board, and that was just too much for consumers. And despite the fact that real earnings are elevated, consumer prices are falling, this is exactly what the government wanted to achieve. You look at what the politically said they were trying to do is bring inflation down, as you see the blue line. But look at this, they're going to be touting the total compensation, this in terms of average hourly earnings multiplied by average weekly hours of production of non-supervisory employees, shown in red here on a year-over-year rate of change, is higher than the consumer price index, and that should be a positive sign. But we know that where consumer prices go, well, wages are soon to follow, and that trend likely to head down. So there's something that the most recent data isn't telling us, because what it suggests is that actually we're seeing hours worked decline. It just hasn't shown up in the reports. And when we look at average weekly hours worked, you can see here between 2022 and 2024, they actually have kind of increased a little bit, but my bet is this is turned down, because you'll note when you look at inflation coming down in terms of demand against hours worked, you see where inflation goes, hours worked tends to follow. Now, sometimes hours worked leads that, which would make perfect sense, but when inflation or demand falls, well, it means working hours are going down as well, and we see that. And the evidence is that Pepsi alone, you see they're saying demand for their snacks goods is going down, means demand's going down. Well, if demand is falling, it means you don't need to produce as much. And it all comes back now to the labor market, and why we started the show out by saying hell is indeed coming, because this is what was not supposed to happen, as initial jobless claims plunged last week by the most in 10 months. And that's the good news, because it came in at 222,000. The problem isn't the initial claims data, it's the continued claims data. If the economy was indeed strong and booming, as the hope was, just to bring demand in line with supply, the labor market should be doing just fine. What we're finding out is demand is getting crushed so much that what's happening in the labor market is going to affect every American household. Look at this. Here you see the continued unemployment claims last week at 1.856 million, which is headed again past towards that critical 1.9 million number that I think if it breaks above that, watch out, it's going to spiral out of control. This week it came in only 4,000 less at 1.852 million. So while 222,000 people filed for claims, the economy only absorbed just about that same number. The problem is the longer people stay on unemployment, the less spending they have in the real economy. And what that indicates is the worst case scenario is we're going to see inflation declining on a huge decline in demand, and that means many Americans soon headed to the unemployment line. And we can see that evidence as we look at average weekly hours. If that does decline, as I believe it will, and weigh in the comments if you're seeing that your employer hours are getting cut. Would love to know. Don't have to say who you work for, just let us know in the comments. Are you seeing more work or less work? Because look at this, when you see continued claims rise or stay elevated, what it means is demand is going down, and that means hours worked are falling. You see that relationship each and every instance. There's a rise in continued unemployment claims. There's little doubt that in the future, as we get more data on average weekly hours worked, that is likely to come down, which is indicating what we know is the problem with the economy. Real earnings, again, inflation adjusted earnings may be fine. It means hours worked is heading down, and it sort of makes sense now why consumers are strapped, despite the fact that the government data indicates that their inflation adjusted earnings are going up. And yes, maybe per hour they're going up, but if you're not getting the hours worked you're used to, and you're having to deal with higher gasoline prices, higher insurance costs, higher debt service costs, well, it makes perfect sense. Consumers indeed, we know, tapped out. Their savings rate near historic lows. This is dangerous. It means, again, we're headed into a recession, and that's going to put a lot of Americans on the unemployment line. As yields sink, as the CPI put September Fed cut in play, and that is absolutely now going to become the base case. And you can see here the consumer price index usually follows a move lower in yields. Here we're looking at 2-year treasury yields. So if you want to know how much the market is pricing in a Fed rate cut, well, watch 2-year yields, because they tend to say where they go, inflation falls. And right now, at least as of today, we're seeing yields move lower. If they continue to go lower over the next couple months, you can all but be assured that the September rate cut is in play, because the Fed, while they say they follow inflation, while they say they follow the labor market, what they really follow is 2-year treasury yields. But yet, as of right now, Powell's in no mood to cut, as he's not prepared yet to say he's confident about inflation. Well, why should he? It's not at his target, but by the time it is, it's too little too late. It's going to go right through that 2% floor. And I do have some confidence that inflation is receding. Well, we have evidence of that. The question is, are we sufficiently confident that it's moving sustainably down to 2%? I'm not prepared yet to say that, but meanwhile, the yield curve, Mr. Powell, tells you that indeed inflation is coming down. It's going to get to your 2% target and continue going from there. And it's going to take the labor market with it, because this is a huge problem we're facing. The economy should be booming here. We should be seeing the second half rebound. The labor market's saying it's not happening. Companies like Pepsi are saying it's not happening. And yet central bankers are saying, well, we're going to see a soft landing. This according to Fed's Cook. I'm not sure what he's looking at, but I don't believe that we're going to see anything close to a soft landing, as my baseline forecast and that of many outside observers, that of course myself excluded, is that inflation will continue to move toward target over time without much further rise in unemployment. He said the Fed is very attentive to the unemployment rate currently and would be responsive if it worsened. There can be non-linearities within these data, and yes, there can be, Of course, Mr. Cook, there also are linearities with the data, and that is when you see, of course, the employment market start to go and Americans hit the unemployment line, it means inflation's coming down because not only is their incomes going down, but their costs to live are going up. And here you can see there is a relationship, not all the time, but notably what you see is when the unemployment rate ticks higher, well, demand goes down. And this is the mistake these central elites have made. They tried to bring the economy into balance, and what they actually did was drive demand down so much, they're going to send us right into recession. You see right here, the unemployment rate trending higher, now inflation coming down, suggesting that what we're seeing here is not a balancing economy, not a soft landing that they wanted to achieve and yet historically never have. What they've done is put the U.S. economy on a trajectory that nobody wants to see. And yet the Fed chief's awful stressed that high inflation is not the only risk the central bank faces. He said the policy committee is paying more attention to the labor market now, given the recent cooling in the data. Well, you better watch those continued unemployment claims, because we know if they continue to go higher, well, what it means is initial claims will follow, and once that happens, it spirals right out of control. Let's go back to where we started the show with Pepsi. As sales disappoint as U.S. consumers, here's the key: cut back on snacks. And it's not just snacks, it's discretionary spending all across the board. We're seeing cutbacks in, and after years of price increases and sales growth, Pepsi's U.S. business is struggling. Persistent inflation has forced many shoppers to cut back on spending and switch to cheaper supermarket-owned brands. The salty snacks category has been particularly lackluster as consumers focus more on nutrition, but here's the key: affordability, needing to stretch what dollars they do have. And in the U.S., there's clearly a consumer that's more challenged. And of course, noting that the added pressures of Frito-Lay are an issue of value, not an issue of anything else. And that is absolutely correct. Consumers have less money to spend, and when they do, they cut back in a meaningful way. And this means, of course, demand goes down, hours worked go down, and people head to the unemployment line. Instead of the soft landing, instead of bringing the economy into balance as they hope to, what the political elites did is tell us hell is coming, and that means a lot of Americans on the unemployment line. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.